Everybody, welcome to the channel. Today we are looking at something slightly different. We are doing a PowerPoint slide on what the S&P 500 is. We're explaining everything to do with it. This is going to be an educational video for those looking to get into investing and those looking to learn the ropes of some of the basics. So we've got slide 1 here, which is of course the intro to the S&P. You may have heard of the S&P 500. It is everywhere in finance. What exactly is it though? And why does it matter so much? The thing is, it's not just numbers on a chart. It is a very good measure of the US economy's heartbeat. Investors, banks and governments all track it for good reason. It also impacts wealth, jobs and retirement. So over the course of this video, we will be breaking it down in a very simple manner. So getting into this a bit more, what is the S&P 500? Now the S&P 500 is an index. It's an index of the largest 500 US companies. That is partially why it's called the S&P 500, right? S&P meaning Standards and Poor's. We can see here it covers all industries. We're talking tech, retail, energy and healthcare. It acts like a scoreboard essentially for the economy. Because these are some of the largest companies in the US, actually most of the largest companies in the US, this works as a very good measure as to how the broad economy is doing. This is going to encompass companies from all across the economy, all different industries, and therefore this is why it's such a good measure of general performance. Now, as I say, it's like a scoreboard. It also includes some giant companies like, for example, Apple, Microsoft and Amazon. This represents around, or the entire index represents around 80% of the US stock market value. So you can see how significant this is. When it moves up, we see growth. However, when it moves down, that generally does indicate the trouble, especially on more long-term timeframes. We're also seeing this watched worldwide as a benchmark. People look at this as to how economies are acting, how economies perhaps should act, and especially how the US economy is acting too. Even non-investors can be affected by its moves for a number of reasons. Now, again, slide 3. As I said, this is created by Standards & Poor's in 1957. It's designed to measure the overall US stock market. Now, it survived recessions, oil shocks, and market crashes. There are key crises to note, such as the dot-com bubble, the 2008 crash, and most recently we have seen COVID, right? So, on top of that, we know that sometimes it drops a lot depending, right? Obviously, if we are seeing a market decline, a market crash, we can see big drops in this, because again, it is simply just a broad indicator of how stocks are doing. Over decades though, it seems to always climb higher. This is a trend that we've seen essentially since it has been created. Now, long-term growth is a big story here. A lot of people put money into S&P 500 index funds with the anticipation of more long-term returns, i.e. a retirement fund or something like that. The S&P 500 also shows America's economic resilience too. So, investing in the S&P 500, right? Average returns on the S&P are around 8 to 10% per year. For example, 1,000 invested 30 years ago could be tens of thousands over time. There's no need to buy all 500 companies individually. They are all encompassed in the index. You can use index funds or ETFs like Vanguard if you are interested in purchasing. It's a very easy way to diversify investments in one simple purchase. Again, as mentioned, you don't necessarily need to buy all of these companies individually. By simply holding the S&P, you hold all of them. Everyday people can invest through 401ks and pensions. As I say, that's a common example of this. It does tend to be a favourite for long-term investors too. It provides simplicity, diversification, and has huge popularity. All notable features. Now, it does come with some risks and things to consider. For example, in 2008, we have seen nearly half of the index value being knocked off. Recessions do always tend to hit hard in the short term. Now, history over the long term shows that this is a strong index, right? The recovery is strong too, and being part of the S&P 500 tends to attract billions in investments. Companies fight to stay in the index because, again, it is seen as a major success to be on there. Tech now dominates with companies like Apple, Microsoft, Google, Meta, for example, all being on there, all being significant players. And generally because of this, when tech stocks move, the whole index tends to shift quite a lot. We see this all the time. Now, the S&P matters to you for a number of reasons. Even if you aren't investing, even if you're not an investor, or even if you're just looking to get started. It tends to impact retirement accounts worldwide, as a lot of the firms that you invest with or retire with will invest that money somewhere, and a lot of the time it is in the S&P 500. It also therefore tends to affect pensions and savings with interest and the like. We also see this as something that influences government decision making and policies. It tends to shape global investor confidence too, and it is, as I say, a massive reflection of strength in the US economy. It tends to be a mirror of growth, risk, and opportunity. Even if you never invest, it therefore still impacts your life. You see it affect people in all different sorts of ways. So understanding it is essentially the key to understanding a lot of modern finance. So, in this quick outro, I hope this video summed things up very nicely. The S&P 500 is more than just a stock list, it's a window into the US economy. It's a powerful investment tool for everyone. It has proof of both risk and resilience over the long term. And it does actually help to explain inequality and growth in the US economy. It teaches why markets matter in daily life, and it helps to grasp an understanding of how money works today. If you enjoyed this video, as always, make sure to leave a like and subscribe. I hope it was useful to somebody out there. Thank you. See you again.